All right. Well, appreciate everybody coming and joining us for our first tax webinar. Really excited to be hosting this for y'all and going through some of the top considerations for taxes when it comes to going into 24. Um, if there's any questions throughout the presentation, feel free to throw them in the chat or raise your hand, and we'll try and answer those as we go along. But there's also going to be time towards the end of the presentation for some Q&A if there's any other questions that we want to get to. And if we're covering it a little later in the presentation, we'll just give you a heads up there that the answers are on their way, and we'll tackle it like that. But without further ado, I can kick it off and introduce our speakers. We've got we've got Eugene, and we've got Benjamin, all formerly KPMG, and they're the best of the best when it comes to tax. They've got the answers. So excited to hear from them as we explore some of the top considerations for 24 and what you need to keep in mind when it comes to taxes. So I'll pass it off now, and we can get started with some of the due dates or important dates to keep in mind for 2024.
All right. Thank you, Alex. Appreciate it. Yeah, so as you mentioned, some due dates coming up as we jump into the 2023 tax season and 2024. The original due dates for some of these tax return types, including partnership S Corp, would be March 15th. April 15th is the 1120 if you're a C Corp, and 1040 if you're filing your personal return, or you're a member LLC and you file that on Schedule C with your 1040. Additional due dates for some 1099s. There are multiple 1099s. The most 1099. Oh, I'm hearing that. The most common 1099 that I see filed by clients are the 1099 NECs, and this is for independent contractors that you have in business, and they are due to be filed with the IRS by the 31st, the end of January, and are due to be delivered to recipients by February 1st. And so just you want to make sure that when you're filing your 1099s for your independent contractors, that you get the information in a timely manner to whoever's going to be preparing your 1099s, and you want to make sure that those are postmarked no later than the end of January, that they get delivered to the client. All right, so Alex, I'm seeing a sidebar with files on it on the presentation. And we can go to the next slide. There we go. So what is an extension? Well, it grants you an additional 6-month window to file your tax return. This does not mean if you have an amount due, it does not grant you an extension of time to pay. The IRS still wants their money by the original due date of the tax return, but it does grant you additional time to file your extension, or to file your return. In order to qualify, you must have the extension filed on or before the due date of the tax return, which we just went over. And in addition to filing the extension, a lot of times, there should be some sort of extension calculation performed, and you might say, well, what is an extension calculation? Well, there are questions that we want to answer before we kind of get into the extension calculation. So if we go on to the next slide, it kind of highlights a few of those things that we want to get answered before we do the extension calculation. So, had the books been finalized the year round? Questions that are still outstanding that you're working with your bookkeeper to answer that would affect the net income at the end of the year. Are you waiting for additional documentation, like a 1099, something that needs to be included on the books before we essentially finalize the books for the end of the year? Those two things certainly will factor into your extension calculation. And essentially what you're looking at doing there, if you do have tax to do, if you have net income through a corporation or yourself personally, you want to make sure that if if you do have net income, you want to make sure that there's a payment that is made before or by the extension deadline, which would be either 3/15 or 4/15. So that's really what we're kind of looking for when we're talking about an extension calculation. Additional things to consider as we're doing extensions, if there is additional information, have you provided all the information to your CPA? If we're doing the books, if Decimal is doing the books, but somebody else is doing your tax return, making sure that you're communicating with the CPA that, the books have now been finalized and here is, the information for purposes of, do I need to make a payment before the extension expires? Additional questions that you might get from your CPA, including us, have there been any major changes to your business? Are you operating in additional states from previous years? Did you start selling in a state? Did you have employees in a state that you didn't previously had? Did you move your operations to a new state and now you have business assets in various states? And so really kind of all those things kind of factor into your extension calculation. And so, do you expect to have a tax liability net income at the end of the year? If so, is there a payment that is due? Have you made estimated payments through the year that would also kind of affect any additional payment that might be due by the original due date of the extension or the. So if you go on to the next page, Alex, estimated payments really primarily apply to C Corps and individuals. And really individuals, you can have income from partnerships, S Corps, your business that is a single member LLC or sole proprietorship, you're filing a Schedule C for those businesses. And then really, if you're looking at, the estimated tax for the current year, you can break it out into, periodic payments. So that's an estimated payment. And really, for C Corps, the IRS really wants their money during the year. So if you do expect to have income at the end of the year, ultimately the IRS is going to say, we are looking for payments throughout the year. And so, making some sort of payment throughout the year would certainly reduce any sort of extension payment made at the end, as I previously said. And individuals can also be making estimated payments. I see a lot of individuals that are filing a Schedule C for their business, and we'll do a year-end calculation when we file the prior year's return. And a lot of times what we do there is we'll say, 100% of your prior year tax is kind of the safe harbor for estimated payments. If you expect to make any more income than you did in the prior year, we can certainly adjust the estimated payments that you make during the year. But this is the minimum amount that you should be expecting to pay. You can certainly adjust those if you're not going to be making as much income in the current year, but work with your CPA to get that information over to them so they can make adjustments to the estimated payments. That applies to both corporations and individuals. And really, we talk about the federal estimated payments a lot. State estimated payments vary. So again, work with your CPA on that. The due dates may vary. The amount that you're going to be paying may vary based on the states that you're either the one state that you're in or multiple states that you may be. If you haven't been making estimated payments and you think you might need to, certainly that is something that you want to sit down and discuss with your CPA. All right. I think at this point we're going to turn it over to, I believe it's Eugene. Is that correct, Alex? Is Eugene on?
Eugene, I think
Eugene is on mute.
sorry.
There you
So
go.
yeah, we wanted to discuss a little bit the year-end planning, tax planning. Always the good plan is to get your books finalized, close to December, and obviously in January you still have a few things to finish up. So, you can't do your taxes till you get the books done. and because you need that for your tax work. So work with your bookkeeper in December and January, try to get everything finalized so that you're ready to go. January comes around. You might have to get additional documents for your tax preparer. You know, it could be 1099s, W-2s. You know, we'd like to, you know, every CPA would probably want them organized in some way to, you know, so you're not sending them a box of receipts. You know, either it's a spreadsheet or some way to organize maybe your purchases or expenses that are not included on your on your books, on your financials, some additional information they might need to get your return done. You know, a lot of CPAs and taxpayers use tax organizers, and those are really helpful because they suggest certain things that you could have missed otherwise. Tell you, you know, what type of income, maybe something you didn't think that should be reported is going to be on the organizer. That's going to prompt you to put some information in or upload some tax forms as well. And then, of course, most companies have to do 1099. So if you had any contractors that you paid during the year, you're generally required to fill out 1099 by January 31st. And for that, usually what you need is the business name or the person's name, their tax ID, their address, and the amount that you paid them. And that's usually just gathering the amounts paid usually takes the most, because you might have made multiple payments and you need to find those checks or payments you made and add them up and provide it to the person who's going to help you with the 1099s, or you could file it yourself with lots of tools available online nowadays. It's pretty easy to file 1099s. So we do offer that service for any of the clients that are interested. We have that service available if you need help with the 1099s.
One thing I
think-
would like to add here for the 1099s, I think business owners need to implement that process of requiring a W-9 from their contractors when they onboard a new contractor. So that form W-9 would provide you the information for the contractor as a name, EIN number, type of entity. So that would be a crucial file to have on file, a crucial document to have on file at the end of the year, so you can determine if a 1099 is required. So for example, if your contractor is a corporation, a 1099 might not be required. Those are typically needed just for sole proprietors, partnerships, both through entities. So by all means, I would recommend, as part of your onboarding process, do get that W-9 from your contractors. That would simplify your compliance at the end of the year. Because we have a lot of clients who come to us with requests to file 1099 and they have not obtained a W-9 and they don't have the contractor information. So that would prevent us from filing the form at the end of the year. One more point here is that a lot of softwares offer electronic delivery of the 1099. So if you can obtain the email address of the contractor, the 1099 can be scheduled to be delivered electronically to them, which would save shipping fees and eliminate, all that printing and mailing.
Yep, great points. Thanks, Steve. And I think we're ready for the next slide. So, some of the other year-end tax planning that, you might have had a tax change during the year, maybe you got married or you changed the tax type of your business, went from a corporation to a partnership or maybe disregard entities. So those things you want to inform to your CPA, maybe you bought a new home and you have a mortgage, things like that. If you're not sure, always ask and say, I'm not sure if that affects my taxes, but I've done this type of changes this year. So some of them are listed here, the change of ownership, maybe you bought a business or became a partner in a new business, or sold your share of partnership in a partnership or a business. Organizational structure changes, like changing type of a business. That happens quite frequently with some of our small businesses. It could be maybe you start as a single member LLC and then they decide to add new partners, and that changes you to a partnership instead of disregard entities. Also, if you buy assets or purchase, certain assets, you can depreciate 100% of the bonus depreciation for 22. And that we're going to discuss that there's some changes in depreciation. So those will also affect your tax returns. And if you're adding new states, so that's a big one with some of our clients, especially with COVID, where a lot of people are working remote from other states. And so when you open, when you hire somebody in your state, for example, you're actually opening yourself up to potentially filing in that state. Or maybe you're opening, like buying a property, like a building or an office or a warehouse. So that also could potentially make you required to file taxes in that state as well. And some of the changes, like I mentioned, getting married, buying a house, or maybe you have a child born that year. So, and that's, like I mentioned, organizers might help you point out some of those changes that you would need to let your CPA know, your tax person know, so they can file taxes correctly.
And if I can jump in, if you don't mind, Eugene, just a couple of points I wanted to add. On the sale of business, typically owners, when they go through a reorganization or a sale of the business, sometimes they don't think about the tax implications, and that can have adverse consequences when it comes time to file the returns. So when you do sell your business, make sure that you reach out to the CPA to seek advice on how to best structure the transactions. There are a couple of different ways to sell your business, whether it's a stock sale or an asset sale, and that could have tremendous implications on how the returns are prepared and how the transaction is taxed. And on the last point here with the new state, I just wanted to bring up the recent, well, not so recent anymore, but the decision in 2018 between Wayfair and South Dakota. So that was a landslide case that basically gave states a lot more power to impose nexus on companies operating in those states. So while the Wayfair versus South Dakota case was focused on sales tax issues, a lot of states are actually transferring that change and starting to impose more strict rules around income tax nexus issues. So do please talk to your CPA when you expand in a new state. And even if you don't have an employee, some states do have what's called a bright line threshold. So if you pass a certain threshold in sales, you might automatically be required to file an income tax return in that state jurisdiction. Those are just the points I wanted to make. States have become a lot more aggressive in imposing nexus on taxpayers.
Yep, let's go and see. And another thing just to mention as well, as I mentioned, the purchasing of assets, kind of like to just mention that if you're really profitable 1 year, you want to reduce your tax burden. One of the planning tools you could do is, if you're planning to buy an asset, let's say new equipment or new truck, within the next year, you might as well buy it in December before the year is over and get that additional deduction, because for 22 you could actually write off 100% of certain equipment that you purchased with the bonus depreciation or the 179 section. The bonus is going to change. We're going to discuss that depreciation, but still, it's going to be a huge. If you bought $100,000, let's say, equipment, then you can deduct that. So maybe your income had 200,000, it was 200,000 for the purchase. Now you drop it down to 100,000. That's a big tax saving. Now it's a timing savings, because you would have had that deduction next year and lower taxes next year, but you're doing it now. So because of time value money, you're saving money now versus later. That's always a better idea to do if you can. So that's something you can discuss with your CPA as well, if you're purchasing something. And even some expenses, like you can pay your January rent in December or something. Usually you can deduct that, in December. So depending on what type of account you're using, accrual versus cash, so that could affect your expenses as well. So definitely discuss those type of big purchases with your CPA. And that's all I have for this slide. And I think Z is we'll talk about next one.
Yeah, so here we've listed some additional year-end tax planning opportunities, and we're gonna go over those, but I do encourage the participants, if you have any questions, we can take a little pause and take your questions as we go through those. Ben, do you want to kick off the list here?
Yeah, some of the tax planning opportunities that I have seen with clients, and it really kind of starts in December, is looking at and trying to get a handle on what your net income, what your expected net income is going to be before the end of the year. And then some things that you can do to reduce the tax liability, either of the income that's flowing through to you personally, if you're a partnership or an S corp, or you're a Schedule C or a corporation, is things like bonus payroll for the owners and employees. If you are looking at a lot of net income and you're a C corp, one really big thing that you can do is issue bonuses. If you issue bonuses, one thing that you can certainly do as well is retirement planning. So with retirement plans, this is another big deduction that a lot of people, I would say, don't necessarily take advantage of. But if you have a retirement plan that it's set up, and if you don't have one set up, certainly a place like Schwab or Fidelity would be able to help you set up. We don't do the administration for retirement plans, but it's certainly something that we can work with your provider for retirement plan services. And one of the things with a retirement plan, you have to have W-2 income. And so if you are, S corp or you're a C corp, you do have to have W-2 income as an owner if you want to make a retirement plan contribution for yourself. A lot of plans that I see, if you're making a retirement plan contribution for yourself, you would have to make a retirement plan contribution, and it's a safe harbor method, which I think is generally around, and don't quote me on this, 3% of their wages. But again, your retirement plan provider would be able to help you calculate those requirements. If you're an S corp, you can certainly make the bonus payroll, and at the end, any income that is flowing through to you from an S corp is not going to be subject to self-employment tax, Social Security, and Medicare. So if you're making a bonus payroll, there might be a situation where you might end up paying more tax in the way of Social Security and Medicare if you're not going to be making a retirement plan contribution. So again, work with your CPA to see if there's any strategies that you can use to minimize the amount of tax that you pay. For partnerships and for Schedule C employee or Schedule C entities, you can still do a retirement plan. There are different options out there, like a SEP IRA. There's additional plans, but again, you have to have income that would be subject to self-employment, which would be income that is from the partnership. So any net income that flows through to you personally is going to be subject to self-employment tax. Any income from a Schedule C would also be subject to self-employment tax. You don't necessarily have to issue self a bonus. In fact, a partnership and a Schedule C, if you're the owner, you should not be issuing yourself payroll. Everything would be subject to self-employment tax already. And so if you do want to make a retirement plan contribution, you'll be looking at kind of the bottom line that is equal to you, and you can make a retirement plan contribution based on it. Other deductions that I see often that people should consult with their CPA, the home office deduction. And this is one that the IRS would be not necessarily strict on, but if they do audit, and this is something that they want to look at, really one of the first things they're going to do is say, is the office, is the use solely for the use of the business? And meaning, are you at the kitchen table, and is there a mixed use portion to your office space? And if so, it's not a home office. The home office has to be exclusively used for. And then, certainly you want to make sure that you're keeping records of documentation for any of these deductions, especially the home office. And then Z can kind of get into the next.
So for the home office, I would just add that, again, to your point, the space have to be exclusively used for business purposes. So there could not be any dual dual purpose usage. So for example, if you set up your laptop on the kitchen island or on your coffee table in the living room, you cannot deduct a home office even though you're working from your living room, because that would be a dual purpose room. Obviously, you're using it to entertain guests or cook food or whatnot. So your home office has to be exclusively used for business purposes. Ideally, it will be a separate room in your house or a separate structure that is attached or separate from your house. And if you do qualify for the home office deduction, there are two ways to calculate those expenses. One of them is the regular method, the other one is the simplified method. And now, under the regular method, you have to add up all of the expenses to maintain your household. So, mortgage insurance if you're owning the house, or rent if you're renting, insurance, utilities, internet, depreciation. But again, depreciation is only if you're owning your house. So once you determine the total amount of expenses to run your household, then you apply a predetermined percentage in order to calculate your home office deduction. And that percentage is calculated by taking your size of your home office, so the square footage of your home office, and divide that by the total square footage of your home, and then apply that percentage to the total amount of expenses that you calculated in step one. There is a second method that is called the simplified method. You can tell by the name that it's simpler to use. Basically, what the simplified method does is applies a predetermined rate. So it's $5 per square foot. That rate is set by the IRS, and you can apply that rate up to 300 square foot. So the total deduction under the simplified method is $1,500. Now, in most cases, the simplified method would yield a lower deduction than the standard method, but there are some advantages to using the simplified method, primarily just the ease of administering. You don't have to keep track of any of the expenses of maintaining your home. You just take the predetermined standard rate, which is again $5, and apply it to your home office, again, up to 300 square feet. Also, another benefit of the simplified method is typically there is less scrutiny by the IRS if you use that method, just because that's a rate that they just give you. Vehicle expenses is another topic or another great deduction that business owners can explore. So, for example, if you use your personal vehicle for business purposes, a portion of the vehicle expenses can be deducted. And again, you have to calculate all the expenses of maintaining that vehicle, whether it's tire changes, oil changes, repairs and maintenance, depreciation. And then after you calculate all of your expenses, you have to calculate your business use percentage. Business use percentage is calculated by taking your business miles and divide that by the total miles that you drive during the year. And I know it's very cumbersome for people to keep track of all the miles that you drive during the year. So that's a major struggle for all business owners. But luckily, there are great applications out there that help with that mileage tracking. So it basically comes down to downloading an app. And once you get in your vehicle, you select whether that trip is business related or personal. And at the end of the year, that application can provide a report that gives you the summary of all the trips that you've had during the year. So we do recommend that you have some kind of a tracking mechanism in place, whether it's a manual spreadsheet or an application. But if the IRS does require if the IRS does decide to look into your return, they would need to look at the support behind the vehicle expense deduction.
Yeah, see, I had an IRS agent ask for this, and they really honed on the log, and the client did have the log based on the application on their phone, which worked out great for them. But certainly documentation on this one is also going to be key. Some of the things that the IRS agent was asking for, where is your home and where is your office? They were backing into the fact that the commuting mileage is not business mileage. So that your first and last trip of the day, whether it's to the office or not, the first and last trip of the day is considered commuting mileage. And so, making sure that, your first trip is, to the post office to your office, that is commuting. And then from there, if there's a longer drive to clients or something like that, that is kind of the second trip of the day, and so that it wouldn't be considered a commuting mileage. And so, yeah, just making sure that you have the documentation there it's going to be key, and really being upfront and timely with the IRS agent if that is something that they're asking for goes a long way to make their lives easier.
Yeah, no, that's a great point, Ben. Especially the commuting versus business mileage. To your point, yes, if the first trip during the day, if that's from your home to your client site, for example, that would be not a deductible mileage. So if you drive from your home to your client A, that's not deductible. Client A to client B, that would be a deductible, and then client B home, that would be non-deductible again. So that's very important to keep track of where you're driving to and from.
The other point that was made there was advertising is not necessarily considered a business mileage. So if you put your sticker on the side of your car and you're going around and doing going grocery shopping or going, to the mall to pick up a present or something, the purpose of the trip is still personal in nature. Just because you're advertising your business does not turn it into a business mileage or turn it into a business mile.
Correct. Also, if you purchase an expensive car and just slap your business sticker on it, doesn't make it a business vehicle. I've had a client who bought a Ferrari and wanted to deduct it as a business vehicle just because he put a little sticker of his business. So another point here with the business expenses, if you don't want to track all of your actual expenses like tire changes or oil changes, the IRS does prescribe a standard mileage rate, which would be 63 cents, I believe, in 2023. They change it every year, but maybe it's 63.5. I don't remember off the top of my head. But there is a prescribed standard mileage rate out there. Again, you have to keep track of your business mileage and then apply that standard mileage rate to that mileage, then that would be your deduction for the year.
65.5 cents per mile. And
they're quite generous then. All right, the next point here is about bonus depreciation in Section 179. So these sections are quite similar in the fact that they both allow you immediate expensing of assets that you purchase for your business. However, there are notable differences between the two. Mainly the bonus depreciation offers you a standard percentage for the deduction, whereas the Section 179 offers you a dollar limitation. To Eugene's point earlier, bonus depreciation used to be 100% up to the end of 2022. And that bonus percentage is starting to go down by 20% starting in 2023 and forward. So that bonus percentage is going to go down to 0 in 2027. So there is a great planning opportunity if you want to get additional benefit. You might want to accelerate those business purchases in 2023 in order to capture the 80% depreciation because it's going to go down to 60% in 2024. Hopefully, Congress extends the bonus provisions and they don't really sunset after 2027, but under the current regulations, they're set to completely phase out after 2027. On the other hand, Section 179 allows deduction for assets purchased during the year, and 179 sets the total deduction amount every year. So, for example, in 2023, the total deduction that you can take under 179 is $1,160,000. Now that limit gets reduced after you pass a certain threshold. So in 2023, the threshold is $2.89 million. So to the extent that all of your business purchases are below that threshold of 2.89 million, you can expense your business purchases up to 1.18, I believe, or 1.16. So that limitation changes every year as well. And discuss with your CPA and figure out what the best strategy is. But those are great provisions to provide full expensing of business assets that are purchased during the year.
Yeah, I think the other point here is there's a difference between bonus depreciation in Section 179 when it comes to states as well.
Yes.
Not all states conform to the IRS bonus depreciation regulations. And so I do see a lot of clients, I think Wisconsin and California are the main ones that I see where it might be beneficial to take the 179 depreciation over the bonus depreciation, because you're able to take that depreciation in the state where, you have to add the bonus depreciation back and then calculate regular depreciation in those states. So there's a difference wise as well. So just something to be aware of when you're discussing your tax. Okay.
Oh, that's a great point. Thanks, Ben.
Yep.
So on the next slide, we're going to discuss the R&D credit, but don't switch the slide yet, Alex. I just want to briefly mention the business meals changes. So briefly, for 2021 and 2022, Congress allowed taxpayers to fully expense business meals. That was done with the sole intention to spur taxpayers to go out to restaurants and support their local economies. So that was a great benefit for a lot of taxpayers, where they could 100% deduct business meals. Unfortunately, starting in 2023, the business meal deduction goes back to 50%, which was implemented by the Tax Cuts and Jobs Act. So that's something that you have to keep in mind. There is no longer 100% deduction for meals. They go down to 50% for meals with clients, or employee meals while traveling, or employee meals while at conferences, etc. So that is something to keep in mind. I'll take a little pause here to see if anybody has any questions, or if we need to clarify before moving to the R&D tax credit discussion. All right, let's.
Can I say one thing about the business meals?
Mhm.
Documentation here is also key with the IRS. And any meal that you're having, in the course of business, it has to have a business purpose for the meal. Are you having it with employees? Are you having it as a group with your firm? Are you having a meal with a client? There has to be a purpose to it. Just because you're the owner and you're going to lunch by yourself does not make it a business meal. So you want to make sure that it has a business purpose for the meal to be deductible, and whether it's 50% or 100% prior to this year. But again, there has to be a business purpose.
Correct. And also there comes a component about entertainment. So for example, if you take a client out to a baseball game and you cover the cost of the tickets and the cost of the meals while at the game, there needs to be a separation between how much of the expense is related to entertainment and how much of the expense was related to the meals that were provided. The portion of the expense, so for example, the tickets, those would count as entertainment. So those would be potentially non-deductible expense, and only the meal portion would be deductible client meals, or 50% deductible client meals. So that's an important distinction to make there as well. That's all I had here. Eugene, Ben, anything to add on the topics before we move on to the R&D tax credit?
Nope, nothing else.
All right, so the R&D tax credit. Maybe people can raise their hand and indicate if anybody has explored the R&D tax credit or thought about it at all. All right, well, maybe we'll do the discussion. Maybe you have a coworker or a business partner that could benefit from these provisions. So the R&D tax credit is a great provision put in place by the government to incentivize businesses to invest in qualified R&D activities. This credit actually dates back to 1981 when it was initially introduced as a temporary credit. But fortunately, in 2015, with the PATH Act, this credit was made permanent. And it's a great incentive for a lot of our clients to pursue R&D activities. Now, what qualifies as an R&D activity? Typically, those activities have to meet what's called the 4-part test. So there are 4 specific tests that the IRS prescribe. And in order for your activities to qualify as qualified R&D activities, all of those requirements have to be met. So the first one is that it has to be a qualified purpose. It has to be technological in nature. It has to involve the process of experimentation. It has to achieve the elimination of uncertainty. So if your activities meet those 4 tests, then you will be qualified, your expenses will be qualified under the R&D rules. Some taxpayers erroneously think that contract labor does not qualify as an R&D expense, but the regulations do do permit the contract labor. If it meets those 4 tests, contract labor would be included as qualified expense for the R&D credit calculation. However, contract labor has to be haircut to 65%. So if you have $1,000 that you spent on a third-party contractor, only $650 $650 would be factored in the R&D credit calculation. The R&D credit calculation, the R&D credit is submitted on Form 6765, which is filed with your income tax return. And there is actually a great provision that was introduced back with the PATH Act, I believe, in 2015, that allowed taxpayers to apply some of those or all of those credits against their payroll tax liability. So in the case, for example, of a corporate taxpayer, the R&D credit is primarily used to offset income tax liability. But for any taxpayers that are, let's say, startup companies, in most cases, those taxpayers are losing money in the initial years of their existence, so they don't have any income tax liability. So that provision to apply the R&D credit against payroll tax was meant to provide an immediate cash benefit to those taxpayers, because in most cases, they do pay payroll taxes. So that is a great benefit that if you're a qualified small business, this is a great benefit that you can explore. The way the payroll tax offset is elected is by checking a box on page 2 of the 6765 and then providing that form to your payroll provider. The payroll provider will then claim the R&D credit on the payroll tax report, Form 941. So if you do have any business partners or if you know anybody who might qualify for the R&D credit, please advise them to explore the payroll offset. That is a great benefit for small businesses. Now, those businesses that qualify have to meet certain requirements. One of them is they have to have generated, or they cannot have sales in any of the previous 5 years. So if you're looking at the current year, the taxpayer must not have receipts in any of the previous years before the 5th year forward. I don't know if I'm explaining this correctly or clearly. So let's say we're in 2023, the taxpayer must not have any receipts for any years prior to 2018. So they must have at most 5 years of receipts to qualify for that payroll offset. And of course, Decimo does partner with some excellent R&D tax credit providers. And if you think that you might qualify for the credit, reach out to us. We'll be happy to make an introduction.
Yeah, Z, on this one as well, documentation is key again. The purpose of the study that Z just mentioned is if the IRS does come and question the credit, having that package available to send to the IRS is going to be very, very helpful. And from our perspective as well, it helps us identify those costs and everything that need to go into the 6765 that is filed with the tax return. So really any CPA that you're working with, they'll likely require the study to be done, and that will help us in preparation of the form that gets filed with the tax return.
And thanks, Ben. And perhaps the last one I want to make here is there were some new regulations under IRC Section 174. Those regulations caught a lot of taxpayers blindsided. They took effect starting in January of 2022. And what those regulations state is that taxpayers are no longer eligible to fully expense their R&D expenses or R&D costs in the year when they were incurred. Rather, those R&D costs have to be capitalized and amortized over a predetermined period. If those costs were incurred in the US, so if you have US wages or US contract labor or US supplies, the amortization period is 5 years. If you have foreign contractors or foreign employees, that amortization period is 15 years. So that provision caught a lot of taxpayers unprepared because the rules under 174 are effective regardless of whether you're taking the R&D credit or not. And those two provisions, the R&D credit on one hand, and the capitalization of the R&D expenses on the other hand, those are two separate provisions. So whether you take the R&D credit or not, the capitalization provisions under 174 are applicable if you have qualified R&D expenses. So that is a huge discussion point that we're going to have with our taxpayers for the current tax year, because it could result in some significant adverse tax implications for them.
All right. Well, now we've got a little bit of time left at the at the end of the call for any questions y'all might have. Feel free to, raise your hand, post them in the chat. Happy to go through some of those at the moment.
I guess I have a question here as I'm looking at this. So, one of the things you talked about is things to consider before you file an extension, and like, are your end of year books finalized? Like, what are some steps people can take to make sure their books are finalized on time, like around January or so? Like, is there anything that they should start thinking through now around kind of preparing for that, or to kind of accelerate that process?
From the book standpoint, the biggest thing is, working with your bookkeeper, whether it's decimal or not, to make sure that if there's any outstanding questions, if there's any outstanding, expenses that have not been recorded in the books, maybe there's a missing credit card statement, that those get taken care of before, I would say before the year ends, so that we can have an accurate idea of where the net income results are, so that if there are any tax planning opportunities that you want to take advantage of, that those get done before the year end. So really, there should be a close working relationship with your bookkeeper to make sure that everything is reflected. Certainly other things that I mentioned, if there's any major changes that it gets reflected in financials. If you bought equipment or if you bought property that you had a loan for, making sure that those get reported in the financials, because there might not necessarily be a cash transaction. It's all, there's a loan that has been set up and you bought a building. So making sure that everything gets recorded before the year end, so that if there are any tax planning opportunities, that we're able to do that.
Cool, thank you.
And another thing, even though we don't recommend it, we certainly understand that sometimes you do have to use a personal credit card or a personal bank account to make a business purchase. Make sure that you give that information to the bookkeeper, because a lot of times that expense might not get captured in the books. So even if you use a personal credit card, if it's a business related purchase, it could be deductible.
In those situations, I recommend that you summarize all of the business expenses that you made personally and physically reimburse yourself with a copy of that summary from the business, so that it gets recorded in the books and you're not just making a journal entry, so that you are reimbursing yourself for those actual expenses, and so that it gets recorded in the books. And again, that summary will help the bookkeeper allocate those expenses based on the category it should be.
And actually, now that you said the reimbursement, that made me think about the home office deduction or the vehicle expense. So before the Trump reform in 2017, employees could deduct the home office expense as a miscellaneous itemized deduction on their Schedule A, subject to the 2% AGI floor. However, starting in 2018, the home office deduction could only be deducted by Schedule C business owners. However, if you have a C corporation or an S corporation, you can submit that home office deduction to the corporation for reimbursement, and then the corporation can reimburse you and take that as a deduction on the business tax return. So that would be the way to take the home office deduction if you're a S corporation or a C corporation business.
Yep.
So just be mindful of that.
I believe there's a question from the group.
Yeah, I do have a question. Hello, thank you for the information today. Question about IRAs, particularly the SEP IRA. Do you know if there's any grace beyond December 31st to make a contribution for this year, or is it hard and fast 12/31?
The SEP IRA, any IRA needs to be paid before the filing of the tax return. Sometimes I think with traditional IRAs, it's the original due date, so that would be 4/15 for most individuals and everything. With the SEP IRA, I believe that is with extension. I know with other retirement plans, like a profit sharing plan, those payments must be made before the filing of the tax return. So if you file your tax return in July, you get to have until that time to make the payment, and that is something that you can accrue on the books for tax purposes to reduce your taxable income for the current year. There, if you're a cash basis taxpayer, there's very few things that you can accrue. Retirement plans.
Okay, excellent. Thank you.
Yep, you're welcome. All right,
Cool.
Alex,
Well,
anything else?
Yeah.
go
Well,
ahead.
just wanted to say thanks for joining us for this webinar. Appreciate the questions and hope this was helpful. We'll send out a replay of the webinar in case there's anything you want to revisit or look at again. But from the sounds of it, it's a good idea to document early and often. Lean on technology where you can to help ease that process so you're not doing so much manual documentation. You've got it nice and digitally recorded somewhere. There's a tremendous amount of ways to produce your tax liability. So if you're unsure about how to approach something or what can be deducted or what options are out there for you, definitely worth reaching out to your CPA or getting in touch with us, and we'll help get you some answers there. But really appreciate the time and thanks for joining us, and look forward to hosting some more conversations like this soon.
Thank you all.
Thanks.
sounds good. Thanks, everyone. Have a nice rest of the day.
You too.